President Trump is a big fan of low interest rates.
Frankly, if we ever got interest rates down where they should be, and if they weren't raised so fast, you would see another probably 10,000 points on the Dow. The Fed acted too soon. I turned out to be right. They acted too soon and too violently.
Hey, what is up, guys? While the stock market continues to reach new all-time high, there are some serious concerns about the current and the future economy remains under question. In this video, we will take a look at the Fed fund rates and the inverted yield curve, which signaling that the recession might be just right around the corner. Currently, stock market reaches new all-time high. S&P 500 surpassed $3,100. This is exactly 11-year financial market expansion since the last 2008 housing bubble and global financial crisis crash. Currently, this is the longest bull market in the history. Eventually, after every bull market, bear market follows right behind it. This expansion led to the bull market to reach all the way to $3,100. That's more than 4 times return on your investment. Mainly, this economic cycle and the stock market was driven by printing enormous amount of money and the low interest rate environment. Since 2008, Fed fund rates were at 0%. This usually happens to stimulate another economic cycle, but it was totally unnecessary to keep interest rates at 0 for so long. In 2015, Fed started to increase interest rates from 0% all the way to embarrassing top only 2.4%. Since then, interest rates have been trending down to the current 1.5%. The reason I believe interest rates are being cut instead of being increased is because we could be already in the recession. I would highly recommend to watch my previous video about Ray Dalio and low interest rate environment. Anyway, many economists and even Trump believes that we should go into negative interest rates. I think this is a terrible idea for US economy. What are the potential outcomes? Well, first, let me explain a quick theory behind negative interest rates. The main idea behind this process is to create demand for goods and services to create another economic stimulation overall. If interest rates are low or even negative, investors can get access to literally more than free money, build businesses, and invest in stock market, while middle-class people will get crushed by low interest rates if they leave their money in the bank. Just think about it. Suppose if in the future we will have -1% interest rates, 99% of middle-class people live paycheck to paycheck. After you receive your direct deposit to your bank will charge you additional 1% to keep your money under the wings. In the end, if middle-class people have some sense of rationality in their brain, they will quickly realize that keeping their money in the bank is a terrible idea. They will be much better off to keep their money under the mattresses. Addition to that, banks will lose the deposits and they won't be able to make profits between lending and borrowing. Therefore, middle-class people and banking system could be in big trouble. Overall, I believe recession will happen regardless. If Fed starts to increase interest rates, economy will crash, but at least we can potentially recover from that rabbit hole. But if Fed decides to bury us into the negative interest rates, economy will crash and will most likely stagnate for God knows how long. Let's take a look at this video that pretty much summarizes negative interest rates environment.
President Trump is a big fan of low interest rates.
Frankly, if we ever got interest rates down where they should be, and if they weren't raised so fast, you would see another probably 10,000 points on the Dow. The Fed acted too soon. I turned out to be right. They acted too soon and too violently. The Fed moved, in my opinion, far too early and far too severely. It puts me at a somewhat of a disadvantage. We'll see what happens with the Federal Reserve, whether or not they finally get smart and reduce interest rates like many other places around the world that we have to compete with. Because if you look at what the other Fed equivalents are doing all around the world, they're at a much lower rate, and it makes us harder to compete.
Recently, Trump even went so far as to praise Germany's 0% interest rate.
In Germany, they have 0 interest rate, and when they borrow money, I mean, when you look at what happens, look at what's going on over there. They borrow money. They actually get paid to borrow money. And we have to compete with that.
Then he went even further on Twitter, referring to the Fed as, quote, boneheads. But what if Trump got what he wished for? What if interest rates were actually zero, or negative like Sweden or Japan? What if instead of a bank paying you to hold your money, you theoretically had to pay the bank to keep it there? It could happen with negative interest rates. Interest rates are generally thought of as the cost of borrowing money. Central banks raise interest rates to cool off an economy that's close to overheating. Zero or negative interest rates, on the other hand, are seen as a way to stimulate an economy. In theory, negative rates force banks to lend more, but it doesn't always work that way. Instead, negative rates can actually have the opposite effect. They can squeeze profits so much that financial institutions actually lend less. They can also have an impact on government funding. For example, Germany's economy is on the verge of a recession, so it's lowered interest rates to negative 0.31%, which means investors could be charged for keeping their money in the bank. But the country still needs to fund the government. So in August 2019, Germany attempted to sell 2 billion euros worth of 30-year bonds, which would mature in 2050, and they had a negative yield. As a result, investors only bought 869 million euros worth, with a yield of negative 0.11%. In other words, investors will, in theory, pay to have the German government hold their money. In the end, the German government was forced to buy the remaining bonds itself, which could push down interest rates even further. At the same time, the European Central Bank, or ECB, has continued on its own negative rate path. The ECB recently lowered its main deposit rate to negative 0.5%, a 10 basis point cut. It also reintroduced quantitative easing as a means to try to stimulate the economy. Negative yields and low interest rates in Europe have also had another effect. They've driven investors to the US bond market in search of safer investments with a yield. Negative rates cause uncertainty in the markets. Many experts believe negative rates in Europe have only had a modest impact on Europe's growth. While it lowered the cost to borrow money, it didn't do anything to increase demand for goods. As a result, businesses didn't invest. Lowering rates even further could put the entire global financial system at risk. Negative rates cause a decrease in margins, which decreases profitability for banks. And that can cause a bump in fees for loans, including home mortgages. They also make it more difficult for a country's institutional investors to find appropriate opportunities for clients. If markets shift, bondholders seeking gains in price rather than yield could get stuck holding too much risk.
Is the financial sector, the banks, the insurance companies, the pensions, the security settlement is all structured, invented on one assumption: positive interest rates.
Marginal reserves?
Yeah, marginal reserves. Everything is on positive interest rates. You take those away, and now the investment decision loses you money in a negative interest rate world. The banking system doesn't work, pensions don't work.
How does the European system work? They're doing a little fudging, aren't they? Some creative movements you were telling me about?
Yeah, the European system works because we, the reserve currency, are still positive. Banks like Deutsche Bank are restructuring their entire worldwide reserve system to invest in US dollars because they've got positive yields. If we go down that road and go negative yields with them and cut everybody off from positive, I think the financial system is at severe stress then at that point.
There's also a concern that negative rates encourage governments to borrow more without concern for growing debt until the rates go up and the bill comes due. And Morgan Stanley CFO Jonathan Pruzan agrees, saying that negative rates provide little relief.
Clearly, the negative rates have not really been helpful to spur the economy in some of these markets, and we'll have to just see how it plays out. But this negative rate dynamic continues to have investors searching for yield, and I think that's a trend that's going to continue because not only are there a lot of negative rates, if you look at the stack of debt products out there, there is not that much inventory that's yielding over 5%. So on the one hand, you have a lot of negative rates, and on the other hand, not a lot of places where you can find yield.
I continue to think there'll be consequences, in the long term for negative rates as an experiment. I certainly hope in the U.S. there's never a consideration of negative rate policy here in the U.S. I think it's interesting to see where we are in the economic cycle, where we are from a job perspective, and just balance the policy that we have today.
I hope you like this low interest rate summary. Now let's shift gear a bit and let's take a closer look at the most accurate indicator that predicted every single recession since 1970s. Let me explain what inverted yield curve is in the first place and why it matters today. If you take a look at this chart, it shows the difference between long-term 10-year and short-term 2-year treasury rates. Every time when the trend goes below zero, which is the black horizontal line, we will see inversion. The most importantly, this is also lagging indicator. On average, yield curve inverts between 1 to 2 years prior to recession. This is exactly what happened in the housing bubble. Yield curve inverted in 2006 and we hit recession 2 years later in 2008. When we were in the recession, yield curve turned back to positive. The same happened in 2001 dot-com bubble. Yield curve inverted in 2000s and we hit recession 1 year later in 2001. If we go into history, before every recession, we have seen an inversion. Well, why does it matter today? Yield curve inverted back in August 2019, which means after the inversion, there is a good chance that we might be in the recession sometimes in 2020 or even 2021. Let's take a quick look at this video that explains yield curve inversion and the recession in simple terms.
Traders often look at the bond market for clues on how the U.S. economy will perform, specifically the yield curve.
Given the yield curve inversion,
we inverted back in March. Yes, we now have an inversion.
Even if the yield curve inversion happens again and happens persistently.
The president tweeting out crazy inverted yield curve.
The yield curve is just a graph showing the relationship between short-term and long-term interest rates of U.S. Treasury notes. Usually the short-term rate is lower than the long-term one. But if you are lending money to the federal government, which is essentially what happens when you buy a Treasury note, you are taking a bigger risk by letting the government have your money for a longer period of time. So you're going to want a higher interest rate to compensate you for taking on that risk. But sometimes this relationship changes. If the two rates start getting closer together, that's called a flattening yield curve. If the long-term rate dips below the short-term rate, that's what we call an inverted yield curve. And the market is concerned about it.
Investors waking up this morning to a recession warning from the bond markets.
The Dow plunging more than 800 points, sparked by a key economic indicator faltering.
A brutal day on Wall Street, stocks plunging as the yield curve inverted, sparking fears that a recession could be on its way.
The yield curve's predictive power has made it a crucial metric for investors and policymakers alike. Many still doubted the yield curve's predictive power, but Astrea's model then successfully predicted the recession in 2001 before the dot-com bubble burst.
The worst day ever on Wall Street. All the major indices are now down for the year.
And perhaps most notably, after a 2006 yield curve inversion, his model accurately predicted the 2007 downturn that became the Great Recession.
Lehman here is going bankrupt.
Some of the biggest names in American business are tonight gone, along with a lot of money and a lot of jobs.
It's important to note that the recessions don't happen immediately after the inversion. But it does mean the clock is ticking, especially when it comes to the 3-month 10-year curves that Astrea has done so much work on.
The peak predictive power is for about a year ahead, maybe a year to a year and a half.
So let's say the yield curve has actually inverted. What happens between that moment and the theoretical recession that the inversion is predicting? Well, a back and forth tends to emerge from market watchers, and the inversion in 2019 offered a good example.
I've been getting this pushback that essentially the yield curve is inverted because global yields are low. So, it's not that good an indicator. I would actually argue it is a very good indicator because we just find it very hard to see how global growth can be this weak and the US can be this one island of essentially prosperity.
I think we're up toward 40% of recession risk within the next 12 months, and that's a large part in reflecting what the yield curve is telling us.
Amongst the curve's detractors, some wondered if the very act of watching the curve so closely had undermined its worth as an economic indicator.
Historically, we had not been following the yield curve as closely as we follow it now. There's something called the Heisenberg uncertainty principle. Something that's being observed is going to act differently than when it's not being observed.
Others pointed to negative sovereign interest rates abroad.
You have 20% more sovereigns yielding negatively than you had just a few months ago. So there's this drive for yield.
Attributing the inversion to a spike in demand for long-term U.S. Treasuries as money fled those negative rates in other countries.
Trade advisor Peter Navarro comes out, Guy, and says it's just a reflection of the fact that everybody wants our debt.
Amidst this back and forth, something interesting happened. The yield curve suddenly uninverted. Does that mean the recession fears were overblown and the naysayers were right? Not necessarily.
Whenever the yield curve uninverts or re-steepens, people tend to be happier, more optimistic. If an inversion is a negative sign, then necessarily an uninversion would be a positive sign. And that may make intuitive sense, but what you'll see is if you look at a graph of inversions and recessions lagging thereafter, the yield curve typically uninverts even before a recession begins. You'll have this inversion with short-term rates exceeding long-term rates, and then it's not uncommon to see that correct itself even in the span between the initial inversion and the recession.
Let me know what you guys think about the low interest rate environment and inverted yield curve. Leave your thoughts in the comment section below, hit that like button and subscribe.